7:30 on the 21st of January. Looking forward to another day of market activity and volatility. I was away from the desk yesterday. I hope you guys traded and survived. I was just talking to the traders here. It's one of those things where if you've missed a day of activity, here I am looking at my chart thinking, wow, that would have been a really, really good session to have traded. But actually, having talking to you guys, it's interesting to find out that, especially actually look during the morning, very, very contained, very narrow price action. Okay, 1:30, 2 o'clock cash market open, we had a bit of a spike. But the majority of the activity, certainly on equities, came in the afternoon, all the way down to 5 p.m. So if you have a look at that sell-off on the S&P, I think this chart doesn't quite do it justice. This is, in the S&P, this is a 2.6% move lower in the S&P, and that's just from 2:30 to 5 o'clock in the S&P. What's perhaps more interesting is then what happened overnight and the rebound in the S&P that we got. Well, this is phenomenal in terms of market opportunity and market activity. Coming from 1804, can you believe it, in the S&P, 1804, all the way up to, I can't quite get to the top there. That's a 3.65% bounce in the S&P overnight. This is the S&P. This isn't the AIM. This isn't the Russell 2000. This is the S&P bouncing 3.6%, over 3.6% during an evening session. And this is exactly the type of market activity and market moves that we should really be trying to get hold of. Slightly unfortunate last night. Obviously, the timing of that move meant many of us would have missed it. But what does that bounce mean for equities overall? I've come in this morning looking at the S&P, having missed yesterday's move lower, seeing this bounce last night on the S&P breaking above S1, breaking above S2. I don't know. I mean, just as we're trading around this pivot level now this evening, I'm very interested to see if this pivot level supports. Also, the pivot level comes in just at, I was just looking at this on the chart, just at the 50% fib level for the move over the evening. So for the rebound, the 50% fib level from yesterday's low to yesterday's high comes in today pretty much exactly where we found support, 1840. And if you guys have your fib level on yesterday's move, you probably all do, I'm sure. Such a clear low and a clear high in the S&P, creating that support at 1840. So good type of market to use your Fibonacci levels when there's such clear identification of highs and lows there. So what was the driver for us to move lower yesterday? Well, yeah, you guessed it. Let's take rocket science. My screen share might have just gone. The sell-off yesterday was the move in oil, the move lower in oil as we got below $28. So I'm looking forward to when our head of trading, Piers Curran, comes in. Obviously, he called, 30, we are just around 30, really. I mean, he was saying that 30 would be a good bottom. I don't know. Now we're below 30. I'm a little bit more bearish than I was. I think 30 was an important level to hold. One thing that Anthony has pointed out to me that's interesting. Well, first of all, overnight we got the API figures due to the bank holiday. They came out yesterday. We've got the Department of Energy figures today at 4 o'clock, remember. So big oil data due out this afternoon. The API data last night, that's the American Petroleum Institute, showed double the build than expected. So a huge build shown last night in the API figures. That normally gives a good indication of what today's DOE data will be. So definitely the environment at the moment is still quite bearish. What I would like to talk about with oil, though, is something a bit more significant, which is about OPEC. So yesterday, you started to get a few comments coming out from the OPEC miners about how dissatisfied they are with the current oil price, and that's understandable, of course. One thing I'd like you to keep an eye on, or just remember, is perhaps you want to take a screenshot of this Bloomberg print. And here you can see, it's just to have a look at the capacity of the different OPEC members, because if you get a comment from Indonesia, so let's say, for example, Indonesia, Reuters news story, Indonesia says they're cutting production. Have a look at their capacity, and obviously they're absolute minnows. Same with Qatar. we all know that Saudi Arabia are the heavyweights. But after Saudi Arabia, anything that's said by Kuwait or Iraq, Iraq are the second largest OPEC member. Anything that's said by Iraq or Iran or Kuwait, Nigeria, this is where the action is really, UAE, of course, as well. So, well, really what we're trying to say is if Qatar, Indonesia, Ecuador, Algeria, Angola, or Libya make comments, then you can pretty much discount them. You're unlikely to get any comments from Iran or Iraq, I think. Both of those are very keen to produce as much as they can. So Venezuela, Nigeria, okay, they're up there, but still relatively small. I guess you've got to look for Kuwait and UAE as the next largest producers in terms of having significance in what they're saying. Just take a screenshot of that and bear it in mind when we start to get the OPEC comments coming through. Now, in terms of OPEC comments, why haven't the big players of OPEC said anything yet? I wonder, I'm trying to put myself into their shoes. At what price point do the big players of OPEC, at what price point does Saudi Arabia come forward and say, right, enough's enough? We will now take action. And it's really interesting. So if we just have a look at oil over a weekly chart here, and this chart is just phenomenal, isn't it? The chart is absolutely phenomenal. If we have a look at oil since 2014, the big mistake that OPEC made was, well, no one can predict the future, but was in underestimating the innovative ability of US shale oil and gas producers. I would say that's the major change here, because this is what OPEC, and this is actually what, if you look at most analysts last year, this is what they thought would happen. Okay, the price slides, then during this period in 2015, hundreds of thousands of jobs get lost in the US oil shale and gas industry, which is exactly what has happened, and the oil price would rebound, which is exactly what happened. What they didn't predict, or what they didn't understand, however, I think, is the flexibility and the innovation of the US labor market, whereby as soon as the oil price got back to 60, look what happens here at 60, test. This is when the producers in the US just hire everyone back. Everyone comes back to work. And in fact, now this move lower here, this is demand side. This was the Chinese fallout in summer. But this move lower here is both demand and supply side. Some of the shale fields in the United States are now producing more than they've ever produced. This was absolutely not expected. Through innovation, cost cutting, and the ability to remain flexible in this type of environment, the US shale industry is proving its resilience. And actually, just yesterday, you saw the first oil tanker leave the US and arrive in Europe. And there's the FT article about it. This was just yesterday. The first US oil tanker arrives in Europe. And yes, very sadly, rather shamefully, this oil tanker is called Liquid American Freedom. Anyway, it is quite a poignant image, though. US oil, due to the change in law that happened in December, just in December, that crude in its rawest form can be exported from the US. So interesting times. Will oil bounce here now, down at $28? You've just got to be incredibly brave to try and predict the end of this run. Not only because of the fundamental factors that are keeping the oil price low, but also because of the behavioral factors. The behavior of oil now, there's just very few buyers. And it reminds me, it's like an opposite scenario of 2007, 2008, if I go back in time here. It's the opposite scenario to what happened here in 2008. When you get enough news flow and enough belief by the herd, by the crowd as a whole, that oil is only moving one way, then we saw this trajectory higher in 2008. And by the way, 2008 is when demand for oil was slumping, so the oil price should have been falling here. But when you get enough critical mass behind an idea, this is when you start to get a behavioral move. Well, we saw what happened to that behavioral move in 2009. But I wonder, are we in that behavioral territory again here now, whereby even if the fundamental news starts to dictate that oil might be bottoming out, the behavior of the market has changed and oil still finds it goes down to touch 20. 20, that's Goldman Sachs' estimate for oil in the near term. They're predicting $20. However, do take what you hear from Goldman Sachs with a pinch of salt. In 2008, at this point here, they predicted oil was set to go to $200. 3 months later, they had to revise that and change it to 30. So nobody actually knows, of course. So very interesting on the oil front. 4 o'clock, that's going to be the big data to look out for, deriving oil. And whilst the correlation between oil and stocks is so tight, you must keep that into perspective. So a monster rebound in equities last night. Oil, though, hasn't really bottomed out. If there is this positive correlation and equities continue to rebound, then you should find that oil bottoms out as well. On the earnings front then, we're deep into earnings season. Some of the US investment banks have been doing well, but just to point out to you guys, Deutsche Bank forewarned us with releasing their earnings early last night. As if you scroll up in the room, you can see this in Anthony's comments. Deutsche Bank released their earnings early last night, and these are terrible earnings. They're posting a Q4 loss of 2.1 billion. So Deutsche Bank, Q4 loss of 2.1 billion, and this is due to additional charges tied against legal and restructuring costs. Deutsche Bank aren't alone in this format. Goldman's have had to pay a charge of over $5 billion due to regulation and legislation. This is why, when I'm advising our new guys in terms of finding a career in finance, understanding the contemporary compliance and regulation market is crucial. Because these fines are so significant for these banks, you do need to be able to have an understanding of why they happen and what the banks can do to avoid them. It's really, really heavy going for the banks, especially as we're about to enter into this environment of market uncertainty, further market uncertainty. Another thing that I'd like to point out, guys, is in the FT, and it's something that I believe quite strongly, is the alarm bells on the US inflation numbers. Now, looking at the current market environment, this is what I find interesting from a monetary policy point of view, is in September, just think about this with me. In September, Janet Yellen said she couldn't raise rates because of global uncertainty. In December, she raised rates, saying global uncertainty has subdued. Well, she didn't mention global uncertainty, but assuming that she said the reason for not raising rates in September was because of global uncertainty, then raising them in December must mean global uncertainty, in her opinion, has subdued. Just 2 days ago, we had Mark Carney speaking at the Queen Mary University of London, coming forward and saying, due to global uncertainty, we might not raise interest rates this year. So from a central banker's point of view, how can Mark Carney and Janet Yellen, both heads of international economies, have a very different view of what is happening in the world around them? Just suppose that Mark Carney's right and Janet Yellen's wrong, and there is global uncertainty currently now in the financial markets. What might the Fed do with rates? And I ask this because if you have a look, this is shown by the FT report here, if I can share this with you in the room. If you look at the US data since the start of the year, any data that refers to inflation has been dire. US inflation numbers have actually been terrible. You've got continued global uncertainty, oil prices are continuing to go lower. GDP growth in the US is around 2%, not 4%. In what environment would this make sense to raise rates the next time they meet? Because the US Janet Yellen was, if you like, forecasting through her forward guidance that there'd be 4 rate rises this year. If you look at go on to CNBC and search Piers Curran, he was saying that's an absolute pipe dream. There's no way there can be 4 rate rises this year. I want to put it to you that is there a chance the US might not be able to raise rates again this year, given this environment of growth? That's certainly what Mark Carney believes is the right thing to do. Anyway, not to put too many cats amongst too many pigeons, because we've got enough cat and pigeon environments as it is already. I just want to put it out there. Listen, so busy. I haven't even mentioned today's ECB meeting yet. Obviously, this is normally a really big front runner for data and market activity, but actually hardly anyone's looking at it today. Very little's expected out of the ECB. It will be interesting to see if there's any comments from the ECB about global uncertainty. See what Mario Draghi thinks. By the way, just to let you know, guys, oil's going back to the lows for the session, $28 trading in oil now. That's also bringing the S&P slightly lower. So this correlation between oil and the S&P still working. S&P breaking below its pivot level. Just to have a look going forward to today then. So we've got the ECB, of course, coming out this afternoon. We've also got the Philly Fed business outlook. Now that will be interesting. That's a behavioral indicator. That's asking businesses in the Philadelphia region, how do you feel? And that's the kind of data I want to know. How do these businesses feel about the next 6 months outlook? Also due initial jobless claims, of course, and we've got 19 of the company 500 S&P CARTs reporting, the highlights being Verizon and Schlumberger. Okay, guys, that's it for the morning session. Oil on its lows, equities being dragged lower by that move. Have a good session. I look forward to working with you throughout the